Hi, I'm Jeffrey Roach, Chief Economist for LPL Financial, with a few key charts to explain what we know about the current macro landscape. First, import prices are lower than last year. Yes, that's right. Despite trade uncertainty, import prices in both June and May were lower than they were at that time last year. Now, granted, the end consumer had to deal with hotter prices in June, and we shouldn't be surprised if inflation runs a bit hotter for the rest of the summer, but the pipeline looks encouraging. Second, monitor discretionary spending activity. We know from previous economic cycles that the first shoe to drop here is consumers' demand for discretionary items. The periods I highlighted just before the 2001 recession and the 2008 recession illustrate this point. And at this point, we do see some slowdown in discretionary spending, but the slowdown is fairly measured. And because of that, investors see this as a time to put money to work and to look for tactical opportunities to take on risk. A good risk manager knows it's important to monitor the macro landscape, so a few good areas to track are travel activity, restaurant spending, as well as demand for new or another vehicle. Third, the Fed should not be aggressive. Yes, it's true. Our Fed funds rate is higher than several other central banks, including the European Central Bank, as I show in this chart. But it's important to note that the Fed needs to remain data dependent and not influenced by political pressures. There is no reason to cut rates aggressively down to 1% or 2% when inflation is above the Fed target, unemployment is low, and the economy is still growing. Yields would spike and the dollar would weaken if the Fed is perceived as a political pawn, so reiterating data dependency is the prudent action right now. I do think the Fed has some room to shave off a few quarter points by the end of the year, but the data do not support a dramatic move as called out by the president. Well, that's all for now. If you want more insights on global market trends, follow us on social media and take care.